There was a piece out by UBS this morning saying that they don't see quite such an apocalyptic version of in emerging Europe that I thought, it was interesting. Obviously, to some extent, UBS is talking its book because if nothing else, there's lots of mortgages in places like Czechoslovakia financed Swiss francs, but which is obviously a killer if you happen to be one of the people paying those mortgages with the currency movements. I just wondered whether you'd had a chance to look at that sort of vision and, whether you had any particular comments on it.
Yeah, well, that's a metric we're looking at very closely. Hungary especially is a very big problem, the Baltics as well with the FX-denominated loans. Now, the question is who's going to come to the rescue of these governments to be able to prop up their currencies? Because certainly I think the fundamental market pressures are for further downside. Now, we've seen the IMF and the EU come in with emergency bailout packages in Hungary and Latvia. However, this really, even in these cases where they were very substantial bailout packages, 20 billion euros in Hungary's case, 7.5 billion euros in Latvia's case, they ultimately did not stem any or reverse the macroeconomic trends, and that's really what's giving us cause for concern. Generally, the widely perspective view, for example, for the Hungarian forint, what level does it start to pose real risks for the banking system was in the high 290s, 300. Well, the forint is now at 305, 310. So there's going to be extreme stresses on the markets, and I really don't see how there's going to be some sort of a magic reversal of that situation over the next 6 months. What we are seeing as a reaction, though, and this certainly plays into our market views, is that governments in the region central banks in the region are no longer going to be able to aggressively cut interest rates. And that's what we're really seeing in Poland and the Czech Republic, where it's now looking likely that they might have to hike just to prop up their currencies. Of course, this is going to be negative treasuries, and this is going to be the credit climate in general, and that could just further protract the recession in these countries.
Justin, could you speak a little bit to what's going on in Russia?
Sure.
It's the R in the brick.
Yeah, it's the R in the brick. We're forecasting growth of negative 4%, so a contraction of 4% in 2009 in Russia. Russia from the get-go was a high-risk country for us, and this is certainly out of consensus for most people who looked at that large pile of foreign exchange reserves and says, well, this is the magic shield that protect Russia. We've seen those reserves fall by about $200 billion within a very short time period. The problem really is that those reserves, which is what everyone focuses on to say that Russia is better positioned, have a whole bunch of obligations to which they're going to have to be continuing to pay out over the next 12 months. Not only is Russia facing a currency crisis in terms of the ruble selling off by about 35% against the dollar-euro basket, but the banking system, the interbank market, has effectively stopped working for about the last 4 or 5 months. So the government is having to inject liquidity into the banking system just to maintain credit at a reasonable level, certainly overnight market. The problem really is a confidence issue in Russia. We have seen foreign investors pull out $140 billion, I think, in the fourth quarter. Now that's roughly 10% of GDP and capital that has just flown out of that economy in the fourth quarter, and we're seeing local retail investors start to lose confidence in the banking system. We've seen about 24 banks go bust, albeit small banks, in the last 3 months. But we've also seen a drawdown in deposits as well. So, again, it's a capital issue in Russia. We see foreign investors pulling out. We're starting to see a dollarization of the economy. We're seeing interbank markets freeze up. And we're seeing local investors lose confidence in the banking system. So there's no capital. The only person that has capital, the only institution with capital, is the central bank and government. And that's really not the recipe for a long-term recovery, certainly not a recovery in the short term, or even a very robust recovery in the next 2 years, is if we're having to rely on the government to bail out banks, bail out corporates, to refinance existing external debt. We're very concerned about the institutional capacity of the Russian government to make up for the foreign investment that has spurred such high levels of growth going forward. And of course with Russia, I'm focusing a lot on capital because I think that is the most forward-looking metric to understand Russia, but obviously the oil price is a huge factor as well. The oil price catalyzed the outflow in foreign investment in the first place, but that was in line with what was going on in global credit markets as well. But so long as BMI, we're forecasting oil to average $43 per barrel this year, it's going to be very difficult for Russia, considering the way its economy is restructured, to rebound so long as oil is below $50 a barrel.
Finally, let me ask you this. What do you see in terms in the region of political unrest?
Yeah, the political risk is a huge factor that's playing out across region. It sort of just represents how systemic this economic issue is because there's no country that's immune from this. Now, in the more sort of developed emerging Europe economies, this is mostly going to play out in the form of greater public unrest, which is likely going to result in greater fiscal spending. You're going to see a lot of pressure for fiscal stimulus in places like Poland, Czech Republic, and Hungary, among others. And as a result, we're forecasting much wider fiscal gaps, which in turn, from a market perspective, is going to result in higher yields for local treasuries. So that, again, sort of accentuates the problem with credit. Now, Russia, of course, is a very interesting case in terms of political risk. And generally, we sort of have a view that the political risk element in Russia is going to play out in steps. And what we've already begun to see is sort of the first step where we're starting to see minor functionaries, minor government officials get the sack. In other words, being placed some of the burden of responsibility for the economic crisis. We've seen some regional governors get fired by Prime Minister Vladimir Putin. Now, the next step beyond that will probably be a cabinet reshuffle at some point, and certainly Finance Minister Kudrin is probably the most vulnerable, considering his portfolio and also considering that he hasn't necessarily had the best relationship with Putin and Medvedev over the last couple of years. Now, the third final step is what happens at the top, the Medvedev-Putin triumvirate that is in Russia, and our view is more likely that Medvedev will get the sack and Putin will take over as president, as opposed to Putin himself being replaced. Putin remains the dominant political power in Russia, but it's also important to recognize that a recession is terrible for any sitting government, and Putin, while he's maintained approval ratings in excess of 75%, that is unsustainable. So we expect Putin's approval ratings certainly to drop fairly considerably going forward, and that's going to add to the confusion about the policy agenda going forward, as well as ultimately who's going to be running the country over, say, a 12-month time horizon.
All right, Justin, thank you. So it sounds like more guns and less butter. So, Greg, do you have any final questions for Justin?
No, that's a terrific rundown. Thanks very much.
Terry, thank you very much.
Hi, guys. Okay.
Incredibly helpful and interesting and depressing all in the same time. Greg, do you have any final thoughts for Terry?
So I would just say that for all the jesting about how depressing it was, investment is, at the end of the day, despite the people who would try to deny it, a reality-based business. And it's much better to, have a clear understanding of some of the headwinds that are out there rather than a lot of the happy talk which emanates from various other places. So I very much appreciate the input, Terry, and the rest of the gang. Thank you very much.
Thanks a lot.
Okay, Terry, thanks for being with me. We'll do this again in another quarter.